Hello, everybody. Thank you for joining us. Given all the recent market volatility and rising fears, we wanted to present this webinar that was given recently by Raymond James Chief Investment Officer and all our research folks, titled Should You Stay or Should You Go? Addressing the question of should you sell or should you stay invested?
The areas we're going to cover today include a brief overview of the headlines that have been driving the volatility. We will start off by giving some perspective on what's been going on in the markets. Then we'll be going over the three big risks that have been huge market focuses, starting with the Ukraine and Russia conflict, economic concerns, and China's zero tolerance policy to COVID and its impacts. And then we will be reviewing what is happening in the fixed income and equity market spaces.
As we sit today, we're off to the worst start for the markets in the last 25 years. January saw the markets fall almost 10%, which wasn't a huge surprise seeing as we were coming off a period of very low volatility. But then the second wave came with Russia's invasion of Ukraine, higher oil and commodity prices, followed then by China's zero tolerance policy, inflation, and Fed rate hikes, all raising fears of a recession.
This has been one of the most violent markets we've seen. This histogram shows the distribution of returns from 1950 till now. To put things in perspective, we've had 18,235 trading days dating back to 1950, and only 245 of those days have had daily returns with plus or minus 3% moves. And we've had 4 of those days in just the past 2 weeks.
That's remarkable. With all this volatility, it's no surprise that the sentiment has been extremely negative. Consumer sentiment near record lows, 70% of people surveyed say the US is on the wrong track. Business sentiment, equity sentiment, all near record lows. The bad news, there's a lot of negativity priced into the markets, but the good news is there's already a lot of negativity priced into the markets. With that, we would caution investors over making any knee-jerk reactions. Trying to time the market is like trying to catch a falling knife twice because you got to figure out when do you get out, then when do you get back in. This chart shows the S&P 500 over the past 20 years, 5,037 trading days. If you just left your money invested, you would have averaged 6.7% return per year. But if you had missed just 10 of the best trading days, your return would have come all the way down to 2.6%. Missing 20 of the best days, 0%. Warren Buffett, arguably one of the most successful investors of our time, has been quoted as saying the stock market is a device for transferring money from the impatient to the patient. Seth Klarman has been quoted as saying the single greatest edge an investor can have is a long-term orientation. And Peter Lynch, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves.
Markets can shift in either direction in a fast and furious manner. This graph shows monthly return performance from the beginning of the year till April. The dotted red line shows this year, and it has been to the worst start that we've seen in the last 25 years, with the market being down 17%. Volatility can be unnerving with drastic swings, but we're also able to see how quickly the markets have bounced back during other turbulent times. For example, we can take a look in March of 2020, during the beginning of COVID, markets were down more than 30%. And during the great financial crisis, markets fell 25% in March. But with both of these cases, we're able to see that these times do not last forever. And if there's one thing to take from this, it's that timing the market is nearly impossible and patience is paramount.
In our March research report, we said the longer the Russia-Ukraine crisis persists, the greater the potential of negative consequences for the global economy. As such, Russia-Ukraine continues to be a major driver. And as you can see here, outside of commodities like wheat, energy, and oil, there really hasn't been anywhere to hide. Even a more conservative portfolio, a 60-40 portfolio, has declined 14% for the year. That's the worst start for this type of portfolio since 1975.
Of all the risks that we assess, this has been the hardest one for us to forecast. Here are some of the potential headlines that could impact markets over the next coming months. Our overall assessment is neutral, slightly tilted to the upside. At best, we hope that Europe will be able to secure their energy needs, that Iran will have a nuclear deal so they can provide more oil to the global markets, and that there is a ceasefire in Ukraine. But of course, there is the risk of the other outcomes unfolding as well.
Are fears of a recession overblown? Our current indicators do not suggest a recession over the next 12 months or so. Some of our long-term indicators, the leading indicators, generally have peaked about 13 months on average before each of the last 9 recessions. The LEI just hit a new record high last month, which would push out that time frame of a recession for at least another year or so. Our short-term indicators like state tax withholdings continue to surge, suggesting that both employment and wages are continuing to strengthen, which means consumers still have money to spend. And then some of the real-time mobility indicators, things like TSA screenings, restaurant bookings, hotel occupancy, all remain pretty close or near post-COVID highs.
Yeah, so to add more to what Yvonne was talking about, we do not see a recession happening within the next 12 months. The economy remains relatively strong, and all of the current economic indicators don't point to that way. Imports continue to increase and showing that the consumer demand continues to be strong. Unemployment has been continuing to decline. In fact, the unemployment rate is almost back to pre-pandemic lows. And then on the third graph, it's showing that cash balances are at an all-time high. And this means that consumers have plenty of ammunition to fight inflation. And overall, these 3 indicators tell us that the economy is remaining strong despite all of the negative headlines that are out there.
As far as inflation is concerned, dynamics suggests that we may have already peaked. For example, used car prices, which have been a really big part of the inflation equation, prices are rolling over, down 6.4%. We're seeing trucking freight rates fall, which is a big component of it as it relates to supply and delivering the supply. The dollar is the strongest it's been since 2002, which is putting downward pressure on inflation because we can buy more international goods for less. And as you can see here, real disposable income is weakening. And every time that you've seen that happen historically, we've seen inflation fall with it.
One of the biggest drivers for this volatility has been the changing expectations for the Fed rate hikes. The Fed is expected to increase rates while it appears that growth expectations are drifting lower. There are fears that rate hikes will create a recession. The Fed faces a difficult task and it will be a delicate balancing act. But so far, we're able to see that the Fed's hawkishness approach has been working. For example, mortgage rates are at 2009 levels and financial condition indexes are all showing signs of tightening. While short-term inflation expectations continue to be higher, longer-term inflation is likely to moderate, which is good.
As the economy is concerned, when we look out at potential headlines over the next 3 to 6 months, we think that the news will be better than the market anticipates. Potential headlines like job growth drives economic growth, inflation peaks, starts to trend lower, Fed engineers a soft landing, global economy avoids worst case scenario, all things that we think will help the markets as we move throughout the remainder of this year.
The markets have also been watching on what is happening in China, particularly their zero tolerance policy towards COVID. China has shut down big cities like Beijing and Shanghai to stop the spread of COVID. And because of these shutdowns, you can see in the first graph that the overall growth has come down pretty significantly and has caused supply chain constraints. The good news is, as it appears, China's COVID cases are rolling over, down 45% over its recent peak, which hopefully means that they'll begin to roll back these lockdowns and that the global supply chains can begin to normalize again. We are more so on the optimistic side of the China headline drivers and think you're going to see more positive headlines in the next coming months. With COVID cases slowing down, we believe that Beijing and Shanghai will fully reopen and that China's economy will grow as they reopen, which would be favorable news for the markets.
The rise in interest rates this year has been absolutely historic. To put this in perspective, the chart on the left here shows that you've only seen this dramatic of a rise on the 30-year Treasury 0.5% of the time. In other words, 99.5% of the time, interest rates have not moved this quickly. And it's not just here in the United States, but really worldwide. And in the bond market, similarly, there really has not been anywhere to hide. If you look at the 30-year Treasury, down 21.2% for the year. Really the worst start for the bond market since 1977. This has been the fastest and worst drawdown we've seen really in the history of the index. And what's driven this rise is the high inflation that we've had, highest we've seen in 40 years, which have led to this massive repricing of rate expectations.
While the Fed is still early in its tightening cycle, it appears that the market is doing its work. The data already shows that the financial conditions are already tightening. Looking at some of the sectors in the middle graph, we've seen 1.5% rise in 10-year treasuries, 1% increase in high-yield bond spreads, 0.5% rise in triple B rated bonds, and another important increase we've seen is the 2% rise in 30-year mortgages since the start of the year. Inflation expectations are beginning to decrease, and this should alleviate some of the pressure on the rate front.
So where does this leave us in terms of the bond market? Well, with the backup in yields, we're finally starting to see an opportunity to get some income from your fixed income allocation. Treasury yields are much more attractive. As you can see on the chart on the left, for the first time, we're seeing treasuries paying more than the dividend yield on the S&P 500. And if we're right about our expectations, we could get some total return, good total return, as we head into the end of the year here.
Using the bull market checklist we have here, all 5 of the dynamics we monitor and take a look at point more towards the bullish side and remain positive. Like we mentioned earlier, the U.S. economy is relatively strong, and we continue to expect growth with limited risk of a recession. Earnings growth is expected to be 9% this year, which is above the historical average. And then taking a look at valuations, with this decline, valuations have become even more compelling. And for corporate activity, dividend growth is estimated to be even higher than historical averages. And lastly, when looking at seasonality, we are currently in the 3rd year of a bull market, and historically bull markets tend to last about 6 years or so.
It's interesting that what we're dealing with now is quite the exact opposite of what helped the stock market go up during these past few years, despite us being in a global pandemic. What you're looking at here is record amounts of money, monetary and fiscal stimulus provided over the past few years, and the stock market, that blue line on the left, going higher. Well, that's all changing, with rates going higher and less stimulus now. And historically, if you go back over the last 8 times the Fed has tightened, volatility has typically been the highest during the first 3 months, which is exactly where we are now.
If you go back to the research from earlier this year in March, our base case scenario was priced at 4,700 about, and we highlighted that our biggest wild cards were inflation and the Fed. Since the March report, inflation has remained sticky and the Fed has become more aggressive, but both of these topics have become huge market focuses, and now we are also factoring COVID shutdowns and other geopolitical concerns. So we forecast for the end of the year that the bull case is less likely, and that our price objective will be between the base and bear price by the end of the year.
When navigating markets like this, it's helpful to think of what's the worst case scenario? What's likely to happen in the next 12 to 24 months? Well, if it's a recessionary bear market, markets tend to go down 34%. If it's a non-recessionary bear market, they tend to go down 24%, and the market's already down 18%. So when do you get your money back? On average, it's a recessionary bear market. New highs are made on average in 23 months, with a median being 9 months. On average, if it's a non-recessionary bear market, we tend to see new highs on average 10 months later, with a median being 7 months later. When we try to assess and look at the potential worst case scenarios over the next 6 to 9 months, we see the downside at 3,400 to 3,600 on the S&P. That's 10 to 15% lower from here, with potential upside being 4,200 to 4,500, which is 7.5 to 12% upside. More importantly, if you look at the chart on the left here, you tend to see the most dramatic moves to the upside, usually within the first 60 days of forming a bottom. Those are the days we can't afford to miss. And when the market's going down like this, there's a lot of forces at work, whether it's fear selling, a lot of traders having margin calls, or these are the folks that have bought on margin that are being forced to sell right now while stocks are trending lower. But at some point, we'll get information that signals the sky's not falling, that the world isn't ending, and that stocks are not going away. But in the meantime, we've got to prepare ourselves over the next few months while we're waiting for the dust to settle, while we get more information about the Fed, about inflation, about the potential for a recession. Stocks are going to continue to be turbulent. And even if there is a recession, stocks will eventually find a bottom and rebound. So to answer the original question, should you stay or should you go? If you're a long-term investor, in other words, you don't need to sell stocks in the next 3+ years, you should definitely stay. Everyone understands, or they know the expression, buy low, sell high. But people tend to do the opposite. They tend to buy high when it feels good and sell low when they're scared. With that, thank you all for joining us. We will continue to keep an eye on things here and continue to reach out to you all. And in the meantime, please don't hesitate to reach out if you have any questions or if there's anything else we can be doing for you. Asia, thank you so much for your time today as well.
Thank you, everyone.
Have a great day. Take care. Bye, guys.
Bye-bye.